Tomorrow belongs to those who prepare for it today. A seed planted today takes root and grows into a tree that bears fruit in the future. Over 110 years ago, a seed was planted. Today, that seed, the idea of excellence, has grown into the University of Pretoria, South Africa's largest contact research-intensive university. 9 faculties and a business school are spread across 7 beautiful campuses, which are home to over 50,000 students, ready to make an impact in the world beyond university and join our global network of nearly 300,000 alumni. Future-focused, sustainably developed facilities and cutting-edge multi- and transdisciplinary research are underpinned by a desire to transform lives and have a positive impact on communities and the world. Excellence in teaching, learning, research innovation, arts and culture, and sports puts us firmly amongst the world's best universities. Knowledge is not just what is in books. It is the wisdom to apply it, to nourish and nurture the seed so that it takes root, grows tall, bears fruit, and branches out. UP plants that seed, that tiny bit of curiosity, creativity, critical thinking, hope, the desire to care, respect, help, and innovate against all odds, to grow, to leave your mark, to excel, to challenge the norm, to think, to rethink, to discover, to inquire, to lead, to have courage, to make a difference, and to persevere. This is the University of Pretoria. We make today and every day matter.
Ladies and gentlemen, good morning, good afternoon, and maybe even good evening, depending on where you are joining us from the world. And welcome to a conversation on monetary policy in the shadow of COVID-19. My name is Nozipho Shabalala, and it is an absolute pleasure to be the moderator of this critical conversation. This is, of course, a conversation that is brought to you by the Faculty of Economic and Management Sciences at the University of Pretoria. And this, of course, is part of our ongoing celebrations of the faculty's centenary. But we also know that 2020 is even more special for other reasons, including that this is the 10th anniversary of Prof. Nicola Vieji as the South African Reserve Bank Chair in Monetary Policy Studies in the Department of Economics at the University of Pretoria. And so this moment allows us not only to celebrate milestones between the two entities, but to certainly celebrate the partnership as well. Before we get started, I am going to throw 2 challenges at you. The first of these is that I think we have a challenge that we could step into to really amplify this conversation into the social media space and, in fact, let the world know how monetary policy trends are surfacing in the shadow of COVID-19. So I'm looking forward to your tweets, your retweets, your insights, your questions, even your comments on our social media platforms. We're using 2 hashtags today. The first hashtag is UP hosts SARB Governor, UP hosts SARB Governor, and our second hashtag is hashtag EMS 100 Advance. That is hashtag EMS 100 Advance. Now that's the first of 2 challenges. The second challenge is for you to claim your share of voice in this conversation. What do I mean by this? The last thing that we want to do is to subject all thousands of you that are on this call with us and in this conversation to just watching a conversation. We want you to be a part of the conversation. And so we encourage you to use the chat function to send through your questions and your comments that you would like me to integrate into the conversation as we proceed. And at this moment, all I can say is that I'll try my best to make sure that your voice is part of this conversation. We've already received hundreds of questions from those of you who pre-registered, so we're working through these to bring them into the conversation. Now, we have a stellar lineup for you today, right from our Dean of the Faculty of Economic and Management Sciences, right through to our Vice Chancellor and Principal, Prof. Kupe, of course, to our keynote speaker, the Governor of the Reserve Bank of South Africa, Governor Lesetja Kganyago, and a stellar, incredible global panel that I'm going to introduce a little bit later on. For now, though, to kick us off and to give us an official welcome into this conversation, it gives me great pleasure to introduce the Dean in a short while. But before we go to the Dean, allow me to also just pick up on some of the key trends that are going to be critically important as we prepare not only for the Governor, who is going to be giving us a keynote address and who's also going to be taking questions from you, but also as we transition into our panel discussion. The context of the conversation is very important. Now, let's remember that the broad conversation is really looking at monetary policy in the shadows of COVID-19. And so in our panel discussion, we're going to take a little bit more detail and ask the question of the future of economic policy in emerging markets. So we're going to take an emerging markets focus. For now, though, allow me to please introduce the Dean of the Faculty of Economic and Management Sciences, Dean Elsabe Lutz. Professor Lutz, it's such a pleasure to have you with us. Over to you. So I'm going to pick up just a little bit there while we get the Dean back up on the line. And allow me maybe to spend another minute or two just fleshing out the context that makes this conversation so much more important. Beyond South Africa, we have seen the Reserve Bank in South Africa responding to the COVID-19 crisis. We've seen the repo rate at a 4-decade low at 3.75%. This, of course, from about 6.5%. But in addition to this, if we begin to look at other central banks in emerging markets, we're seeing a couple of trends. We're seeing a widening scope, if you will, of central banks responding to COVID-19. We're seeing quantitative easing, we're seeing yield targeting, we're seeing credit guarantees, as well as a range of other ad hoc interventions. The question, though, is to what extent are we also seeing mounting pressure on central banks to really begin to fund treasury or the equivalent of treasury in other markets in order to alleviate some of the fiscal pressures that oftentimes limit government's ability to support the economy. Now, this is the context against which our panel discussion is going to be taking place. And our panelists who are actually going to be joining us come from across the world. So we have Dr. Elias Al-Bagli, who is a director of the Monetary Policy Division, this at the Central Bank of Chile, and he's standing by to share some of his insights on this question, and in particular to give us the Chilean experience as well. We've seen a range of interventions from the Central Bank of Chile, rather, and really for him to unpack the rationale behind some of these interventions, and also to speak to perhaps the changing role of central banks as we're seeing them, and using Chile as an example that we can extrapolate and look through to understand what's happening in other markets. We're also going to be talking to Ms. Elena Rybakova, who's a Deputy Chief Economist at the Institute of International Finance, and in the panel discussion we'll also be joined by Prof. Nicola Viegi, of course, who we've introduced as the South African Reserve Bank Chair of Monetary Policy Studies at the University of Pretoria. I am told that Prof is ready for us, and so Prof, I'm going to hand over to you to give us the official welcoming remarks and to open this conversation.
Thank you, Nozi. My apologies for my disconnect, but good afternoon to all. Honourable Governor Lesetja Kganyago, Vice Chancellor and Principal of the University of Pretoria, Professor Tawana Kupe, distinguished panel members, Professor Steve Koch, Head of the Department of Economics, and all virtual participants. On behalf of the Faculty of Economic and Management Sciences, it is my pleasure to welcome you all at this webinar on monetary policy in the shadow of COVID-19. The extent of the pandemic has caught us by surprise. The world was initially, and rightfully so, concerned about the spread of the virus and the impact on the health of citizens and on health services. The economic consequences of the pandemic are now on top of the agenda of policymakers and global governance institutions. It is clear that the economic policy responses and maneuvering will determine how countries and the world economy would recover from such a devastating event. The Faculty of Economic and Management Sciences celebrates its centenary this year. The faculty was established in 1920 with a small cohort of 32 students during an era when a single degree was offered and contents were adapted on short notice in order to serve the immediate needs of the majority of students which were working in public service. Today, we offer a wide range of undergraduate and postgraduate degrees in financial, economic, and management sciences and in public administration. We are proud that all our subject fields are recognized on various international ranking lists. Since the Department of Economics was one of the founding departments and now also hosts the South African Reserve Bank Chair in Monetary Policy Studies, we are proud to celebrate this virtual centenary event in association with the South African Reserve Bank, with which we have a long-standing relationship. I wish to thank Governor Kganyago for his acceptance to present the keynote address today. I now call on the Vice-Chancellor and Principal of the University of Pretoria, Professor Tawana Kupe, to do the introduction. Professor Kupe.
A very good afternoon to everybody who's gathered here. Allow me to make some acknowledgements and give my remarks. Governor of the Reserve Bank of South Africa, Kganyago Lesetja, Dr. Elias Albagi, Director of the Monetary Policy Division, Central Bank of Chile, Dr. Elena Rybakova, Deputy Chief Economist at the Institute of International Finance, Professor Nicola Viegi, the SARB Chair of Monetary Policy Studies at the University of Pretoria. Moderator, very able moderator and UP alumni, Nozipho Chabalala, conversation strategist and moderator. Members of the UP Executive, Professor Elsa Bilutz, Dean of the Faculty of Economic and Management Sciences, Deans of Faculties at UP, Heads of Department in the Economic and Management Sciences Faculty, staff and students, and all our esteemed guests who are here on this webinar with us today. A very good afternoon to everyone who's attending the webinar. We have a very impressive attendance of, just before I spoke, 912 people, but rising every second. This webinar is part of our celebration of the centenary of the Faculty of Economic and Management Sciences at the University of Pretoria, which has for those 100 years been a major contributor to human capital, research and engagement that is key and critical to economic development and the quest for prosperity for our country, South Africa, our continent, Africa, and indeed the world. Our graduates can be found across many professions and institutions, public and private, but also across the globe, making stellar contributions in diverse fields. They are key to the transformation of society. And I strongly believe that beyond COVID, our graduates will still be in that space, making a contribution to the new pathways we have to find to create new inclusive sustainable economies and new inclusive sustainable societies that respect the use of resources and respect nature. One of the ways the university enables all of this to happen is pursuing industry-funded chairs that enable significant training and cutting-edge research that translates into policy. The bank is not an industry, but it is also an external funder of chairs. UP has been fortunate to hold one of the chairs funded by the South African Reserve Bank. For that partnership, we are deeply grateful, Governor. and we will work to ensure that value is created and the relationship lasts forever. Governor, ladies and gentlemen, allow me to indicate some of the achievements that have come with the generous support of the South African Reserve Bank. There are now 2 agreements that we have signed with the SARB since the beginning, and some of the important highlights of the chair agreement are: the initial agreement between the SARB and the Department of Economics (UP) was instituted in 2007. It was for a chair in monetary economics and for a period of 3 years. Professor Nicola Viegi was appointed to the SARB chair in 2010. The chair was renamed in 2017 to the South African Reserve Bank Chair of Monetary Policy Studies. The chair currently funds 4 postdoctoral fellows in monetary policy studies: Dr. Sierra Del Eva, Dr. Ekaterina Prizhikova, Dr. Vincent Dada, and Dr. Tumisang Loate. There have been 7 South African monetary policy economics workshops with participation of researchers from around the world. There have also been 3 graduate training in monetary politics workshops. The chair also sponsored visitors to South Africa include researchers from the University of Warwick, London Business School, Newcastle University, Bank of Norway, University of Milan, European University Institute, University of Namur, the New York Federal Reserve Bank, and Bruegel. Under the chair, 8 PhD students have completed their studies. 3 were funded from the chair. 2 of these have received the Economic Society of South Africa's Founders Medal for completing the best PhD research project in the country. And these were Hakun Kavli and Tumisang Loate. 8 PhD students are currently under supervision, 3 of which are funded from the chair. 30 master students have completed their degrees. At least 20 of these have received partial funding support through the chair, and a further 16 have received full funding. At least 16 are female, very important given we're in Women's Month and gender equality is a struggle we still have to ensure we succeed in, both in economic domains and generally in society. At least 17 are Black South Africans, very, very important. One of these Black South Africans received a Fulbright scholarship to study a PhD in the US, and that is Hope Losha Muronga. 10 additional master students have been able to gain international exposure in New York at Fordham University, which is one of our major partners in training, education, and research in the area of economics. The second agreement is an MPhil PhD Fellows Agreement. A few highlights are as follows. In 2016, under the direction of the current South African Reserve Bank Governor Lesetja Kganyago, the SARB instituted a program to increase the number of PhD recipients in economics from disadvantaged communities. The program funded both high-level master's coursework and PhD studies, thus allowing them to be full-time students and scholars. Very important. This first student funded under this program has submitted a PhD for external examination, with 3 additional submissions expected in next year in 2021. One of the students received the Economic Society of South Africa Founders Medal for completing the best master's level research project, economics, in the country. Ladies and gentlemen, through the generosity of the bank, the partnership and the collaboration, this is what has been achieved in relation to the human capital and training of students. More has been achieved in the research domain, but I'll allow the professor who will be speaking to that. Allow me now to quickly introduce the governor of the Reserve Bank, Lesetja Kganyago. Lesetja Kganyago was recently reappointed as the governor of the South African Reserve Bank for a second term. His first was effective from 9 November 2014. He had been a deputy governor of the SARB since May 2011. In this role, he was responsible for a wide range of areas, including research, financial stability, bank supervision, financial regulatory reform, including introducing the Twin Peaks regulatory structure, which is one of the best practices in this domain. Financial surveillance, including taking responsibility for the regulation of cross-border flows, risk management and compliance, and functions of the SARB Academy. Governor Kganyago has more than 20 years of experience in formulating and implementing public policy, having spent his time at the Central Bank and at the National Treasury. During his time at the National Treasury, a fundamental reform in the management of the national debt portfolio was completed, and he successfully steered several public finance and financial market reforms. Governor Kganyago has led South Africa's technical team in various G20 Minister of Finance and Central Bank Governors meetings and summits, including the inaugural summit in 2008. He has chaired the IMF World Bank Development Committee, deputies, and the G20 Working Group on the IMF governance reform. He was also the vice chair of the Financial Stability Board Standing Committee on Standards Implementation for 4 years. Currently, Governor Kganyago chairs the Committee of the Central Bank Governors of the Southern African Development Community and co-chairs the Financial Stability Board's Regional Consultative Group for Sub-Saharan Africa. He also chairs the Financial Stability Board Standing Committee on Standards Implementation. He was appointed as the International Monetary and Financial Committee, IMFC, chief effective from 18 January 2018 for a period of 3 years. The IMFC is the primary advisory body of the IMF Board of Governors and deliberates on the principal policy issues facing the International Monetary Fund. Governor Kganyago holds a Master of Science degree in Development Economics from the University of London School of Oriental and African Studies and a Bachelor of Commerce degree in Accounting and Economics from the University of South Africa. Ladies and gentlemen, our Governor, Governor Lesetja Kganyago.
Thank you very much, Vice Chancellor. The Dean of the Faculty, the Head of the Department of Economics, all professors observed. Good afternoon, ladies and gentlemen. We are in the middle of a COVID crisis, but there are very important lessons that I would like to share with you today. And I would like to locate this within the context of 20 years of inflation targeting in South Africa and elsewhere. For 2 decades, we have been part of a great international experiment in getting monetary policy right. Inflation targeting has delivered a long period of stability, compared to the best years of the post-war British system, and should be considered a success in South Africa and for many other countries. To understand how we got to where we are now, looking back at 20 years of inflation targeting, we can start further back. We reach from 1979, titled The Anguish of Central Banking by Arthur Burns, who was chair of the US Federal Reserve for most of the 1970s. This was a period of high inflation in the US and globally. Burns asked why inflation was proving so stubborn and why central bankers failing to stop it. He offered a remarkable confession that the Fed could have stopped this inflation at any time, but it didn't because it lacked the will to do so. To quote from the speech directly, open quotation, inflation came to be widely viewed as a temporary phenomenon, or provided it remained mild, as an acceptable condition. Maximum or full employment, after all, had become the nation's major economic goal, not stability of the price level. that inflation ultimately brings on recession and otherwise nullifies many of the benefits sought through social legislation was largely ignored. Close quotation. During Burns' tenure at the Fed, inflation averaged nearly 7% in the US, well above the 2% levels of the preceding 2 decades. The decade ended in tears. Indeed, the decade ended in tears, with high inflation giving way to falling investment and growth, and eventually a sharp and persistent increase in employment, which took years to resolve. How easily could we have made the same mistakes? We could have said that with high unemployment and such great economic demands after apartheid, it was just not possible to control inflation. And we would have ended up with no social benefits, no growth, no extra jobs, but with high and stubborn inflation instead, just as it did with Burns. But the story of South African central banking in the democratic era is not one of regret. The 1980s and early 1990s made it very clear that high inflation creates uncertainty, destroys savings, and undermines growth. The growth-inflation trade-off doesn't work. We realize that inflation targeting as a transparent and accountable policy framework provided our best shot at price stability with growth. In fact, the inflation targeting era has been one of lower inflation and lower interest rates than prevailed previously. Following our mandate, inflation has been kept under control. Even now, at this very difficult time for the economy, we can see the inflation targeting framework functioning properly, delivering historically low interest rates in the context of low inflation. What are the chances 20 years from now that we will still have price stability and low interest rates? Will we be agonizing 20 years from now over how we lost control of inflation? Today, there is a new generation coming of age in very difficult circumstances. They have many questions about the economy in general and about how monetary policy fits into the picture. Some of the questions are asked in a fiery tone, and I think that young people like to be angry. Not only have they been unlucky, reaching adulthood during one of the worst economic disasters in modern history, they are also now discovering that over the past 10 years, South Africa has been accumulating at a rapid pace, faster than any big emerging market, bar Argentina. So, while the economy struggles to grow and job creation remains elusive despite the spending, there is a heavy burden of debt for future generations to carry. Justified though this anger is, we need to channel that energy into positive action. We also need to guard against making policy mistakes that could sink us into deep. Perhaps in the audience here today, there are future macroeconomic policy makers, future Reserve Bank governors and finance ministers. There are surely many people who will be leaders in this country in one role or another. Speech is primarily about you. You will decide much of our economic future through choices and the ideas behind them. we are giving you many problems, but at least we have achieved price stability. It will be up to you. Here are some lessons we have learned to help you do that. The first lesson has to do with Arthur Ben's problem, which is about losing track of your mission and living to regret it. Perhaps the most common criticism of inflation targeting over the past 2 decades has been that South Africa needs a more friendly monetary policy. Burns, however, learned the hard way that there is no permanent gain both from short-term increases in inflation. While we would all like South Africa to reach permanently high growth, this is beyond the powers of a central bank. As we have often communicated, most of our powerful problems should be addressed through structural reforms and confidence-boosting measures. To give just one example, the central bank cannot stop electricity loading with interest rates. The South African Reserve Bank can be held accountable for achieving low and stable inflation. But economic growth requires collaborative effort. It is simply not within the power of one institution to deliver it. It is a team sport. It needs contributions from education, from the development finance institutions, from the private sector, and from many other players. Our emphasis on growth as a team sport, however, does not crowd our concern for the specific problem we can address, which is weak demand. Right now, demand has been badly damaged by the coronavirus lockdowns. In technical terms, we think the output gap is deeply negative. This fits into the APC's policy stance. We have slashed interest rates to support aggregate demand and the spending power of South Africans. In doing this, we are supporting that part of growth in the near term which we can influence. We have become clear about this in recent years, including, as part of this, adopting the quarterly projection model as a main forecasting tool for the Monetary Policy Committee back in 2017. The quarterly projection model sets out a proposed path for interest rates, which it gets from a so-called Taylor rule. That rule responds to the output gap as well as inflation. Indeed, because the output gap also affects the inflation rate, the rule responds to weak growth twice. The output gap gives us a measure of slack, and that gap, in turn, has an impact on inflation. Would it make sense to add growth or employment to the mandate of the SARB alongside the price stability mandate? I'm sure it is possible, but I doubt this would change policy much. After all, we already include growth in our models and decision making. Through the output gap, a comprehensive map of economic slack. The problem is that formally adding an extra mandate in a context of our propensity to stagflation could encourage policy mistakes and weaken credibility. South Africa's growth and employment problems are bigger than monetary policy. For instance, even when the economy was booming, unemployment stayed above 20%. As with growth, the bedrock of this problem is structural, not cyclical. In this is the legacy of Bantustans, apartheid education, and the failure to fix those problems. Our labor markets have also historically raised the cost of hiring people even when the economy is weak and people are losing jobs. This cost inflation has further undermined job creation even when growth picks up. For these kinds of structural reforms, an employment mandate is likely to be effective. More likely, we would find ourselves in other burdens. We would not get unemployment permanently lower, but we would be stuck with higher inflation, making our growth and jobs challenges even worse. We want to be crystal clear that we won't make that mistake. With inflation well anchored, moves to lower interest rates should get us more real than inflation. And this is exactly where we are now. But doesn't everyone have low inflation right now? Isn't this due to coronavirus, not monetary policy? Well, this brings me to the second common argument we have had, which is that lower inflation has been a common phenomenon, not an accomplishment of inflation targeting. There is no doubt that global factors affect inflation. Globalization and low-cost manufacturing have made goods cheaper. The recent collapse in oil prices has been a big disinflationary shock. But we also have good evidence that countries with independent inflation-targeting central banks have lower and less volatile inflation. And we can see that there are still countries with high inflation rates, despite low global inflation. The easy examples of this are the hyperinflation cases like Venezuela and Zimbabwe, but there are less extreme cases that show the value of sensible monetary policy. Consider Turkey, a middle-income country like South Africa. In June this year, Turkish inflation was 12.6%. In South Africa, it was 2.2%. Both these economies have had low growth of less than 1% before COVID-19 hit. Both countries experienced big currency depreciations this year. Both are major importers of oil and have benefited from its collapse. So why are their inflation rates so different? The point here is that the independence of the central bank matters, with the experience of other emerging and developing economies bearing testimony. Since 2015, Turkey's inflation rate has averaged 11.6% against a target of 5%. For the same period, South African inflation has been within our 3.6% target range, averaging 5%. Examples like this make it crystal clear that low inflation is not just a worldwide fact that countries can have for free. If individual countries don't make an effort, they can easily get stuck with high inflation. The next argument is that inflation targeting is a rich country policy, inappropriate for market markets like South Africa. In fact, inflation targeting has been adopted widely by emerging markets. This makes sense, as many of us have learned from bitter experience that tolerating inflation isn't developmental. It just creates instability. Tolerating inflation isn't developmental. It just creates instability. It is worth noting that there are more developing country inflation targeters, about 25, compared with 11 among the advanced economies. And while New Zealand gets the credit for being the first to implement inflation targeting, the second country was an emerging market, Chile. Differences between advanced and emerging economies tend to be reflected in target designs that are not one size fits all. Most rich countries have found they like a 2% target, but emerging markets have used other sizes, often 3% or 4%. Most recently, critics of monetary policy here in South Africa have flipped by 180 degrees. The SARB was originally accused of wrongly importing a first world policy to South Africa. But now we are told to follow major advanced economies and launch a big quantitative easing program. So much for the calm that rich country policies don't work in developing countries. This brings me to the next part of my speech, which is really about new challenges to inflation targeting. In South Africa, there is a surprising amount of interest in QE. From being arcane jargon, many people have suddenly developed passionate views about it, and it gets lots of media interest. Given all this, let me summarize where we are in this conversation. As I explained in a recent speech at Wits University, quantitative easing will become appropriate when interest rates are at the zero lower bound and there is deflation risk. While inflation has eased and created space for lower rates, I am not aware of any professional analyst who predicts deflation in South Africa. Our own sub-forecasts are in line with this consensus. Nonetheless, should deflation take root, we would be prepared to deploy the tools at our disposal as appropriate to achieve our mandate. Our inflation targeting framework would help us make that decision and would underpin the credibility of any step we might need to take. In the current circumstances, however, we think that a quantitative easing program doesn't make much sense for South Africa. Some advocates of quantitative easing argue that it is a way of financing government deficits. Of course, this is not true. The funds created to buy bonds would flow into the interbank money market, lowering the cost of funding. This cost of funding is in fact the repurchase rate, which is our main monetary policy tool. To ensure that the repo rate stays where the MPC wants it, despite the extra funds in the system, we would have to borrow those funds back ourselves, which could be costly. To repeat, quantitative easing would not be free money. Nonetheless, there are still claims that quantitative easing could work because the SARB would buy long-term bonds at a high interest rate in the region of 9%, and then pay sterilization costs equal to the repo rate at 3.5% currently, and profit from the spread, borrow at 3%, lend at 9%. What a great business model it would be. But fortunately, the South African Reserve Bank is driven by public interest and not by profit. And clearly, there are some risks embedded in this pricing. Our or private buyers would simply take these profits. They would have had an opportunity to eat this free lunch already. In fact, we intervened to bring down long-end bond yields. We would be transferring risk back to the public balance sheet, whilst also removing incentives for new lending to the public sector. One of South Africa's fiscal advantages is that the average maturity of government debt is unusually long relative to that of our peers. At the start of this year, it was a bit over 12 years. The whole point of borrowing long-term like this, even though it costs a bit more, is to share risk with investors. This means that when things like the coronavirus and credit ratings downgrades happen, bond prices fall and borrowing costs go up. But this debt need not be rolled over at interest rates because government has already received the funds long-term at the old interest rate. The risk is shared. But should the SARB start doing QE, however, by buying bonds on the secondary market? Well, if that was to happen, then investors could shift risk back onto the public sector balance sheet at a higher price. In other words, it would be a private sector bailout arranged by the SARB. Worse, QE would reduce the incentives for new investors to come and buy long-term sovereign debt because there wouldn't be enough yield or compensation for longer-term risks now visible. What happens with QE instead is that public borrowing switches to the short end of the curve. As the central bank buys long-term bonds, it also sells to the private sector short-term instruments in their place, with the net result that the only new debt the private sector ends up with is that short-term debt. Given that our short-term instruments like SARB debentures are like national treasury bills, it turns out that QE is much less exciting than it looks. Not only can national treasury effectively make its own QE by funding itself through treasury bills, but it actually is doing so. Its pre-crisis borrowing strategy was astute. It left room in the end of the yield curve to borrow in an emergency. Lower inflation and a lower repo rate have made that borrowing cheaper than it otherwise would have been. In these circumstances, it's not at all clear what a SARB quantitative easing program would add. Rather than trying to supplant private investors or take away the risk of investing, we have focused on liquidity. Specifically, we have been buying bonds in the secondary at maturities in the context of a sudden stop in global capital flows. As the central bank, we have unique powers to provide liquidity, and we have used them to restore market functioning. These interventions have been helpful so far. Yields have fallen. We didn't set out to lower the yields specifically, but it turns out that dysfunction was part of the reason why yields were so high. So, putting all the pieces together, this monetary fiscal mix allows more spending in the context of a major emergency. We are happy by setting low interest rates and by ensuring the government bond market remains liquid. National Treasury is able to sell its debt to investors. This approach is going to deliver a historically high government spending this year, even adjusting population growth and inflation and excluding interest costs. National Treasury is not cutting spending in the middle of a crisis. They are raising it to the highest levels on record. However, we also need to think about the next few years. National Treasury is already planning deficits of 14.6% of gross domestic product this year, 9.3% of GDP next year, and 7.7% of GDP the year after that. In this context, high long-term interest rates are a critically important signal about what savings are available. We should be listening to this message, not try to temporarily suppress it through sub-interventions, which can just switch long-term debt for short. We are in very difficult circumstances, but quantitative easing is not the answer. We need to focus on real solutions. Our discussion of QE takes to the final part of my talk to you this afternoon. It is about new challenges to the inflation targeting paradigm. Kevin King, the former governor of the Bank of England, has noted all previous monetary policy paradigms have fallen sooner or later. The current will also be replaced eventually. One that's better for future circumstances. What might change? Many of the advanced economies, inflation targeting is challenges. Inflation been below their inflation target for many years now. Rates stuck at zero. And instruments like quantitative easing and market guidance have not been powerful enough to solve the problem. It is hard to explain the Bank of Japan or the European Central Bank has been unable to push inflation to targets of around 2% despite these aggressive monetary policies. At this stage, there is little consensus on the answers and less on positions. There are two basic set explanations for why inflation has stayed so low in advanced economies, why central banks are unable to lift it. One emphasizes beyond the control of central banks, such as changes in labor markets or demographics. For instance, in an aging society, people want to save and they don't want to risk. So demand is limited and interest rates are low. This explanation works well for places like Japan. Another kind of explanation puts the emphasis on where borrowers have debt, even small interest rate increase like effects on demand, while large rate cuts boost it further. As one in this literature puts it, the black hole of debt is inescapable. Down inflation and interest rates. An alternative version is that low interest rates encourage financial risk-taking, which leads to crisis, depressing the economy, lowering inflation, and generating even lower interest rates. In these cases, loose monetary policy eventually causes very high debt levels that smother economic growth, or it ends up causing financial crisis. I don't think South Africa has these problems yet. Right now, we don't have the high inflation and high interest rates of the past, but we also do not have zero rates and close to zero inflation of the rich countries. The inflation targeting paradigm is working pretty well. Given all the challenges facing South Africa, we must recognize that monetary policy is the last place where we should consider risking changes. We have an established targeting framework, which is delivering low interest rates and inflation. This is the most functional part of macroeconomic framework. Unfortunately, getting monetary policy right isn't going to be enough. South Africa's debt situation is critical. Our rebound from lockdown is looking weak compared with other countries. As a country, we need to find a path back to fiscal sustainability and growth. We borrow from new creditors. We shift our debt towards borrowing. We can move things around different sheets. This is not a strategy. It's just a way to buy time. If public sector borrowing were the way to achieve sustained growth, the last years of debt accumulation should have produced spectacular growth. They did. The real now is restoring our fiscal ability and implementing structural reform so the economy has a way to become more efficient and grow. As a country, we seem to be depressed, unable to get out of bed. Yes, it's winter and it's cold. But we can't live like this. Spring is coming. Inflation and interest rates are low. What we need is to focus on the opportunities. We must get up and get to work. We can get South Africa working. Demonstrated as a country our ability to conquer adversity. We can conquer. Thank you very much for your attention.
And that's a very big thank you to Governor of the South African Reserve Bank, Governor Lesetja Kganyago. Thank you very much, sir, for deep insights that you've shared with us. I'm going to pick up on your last point. There are opportunities. We should focus on these opportunities. We need to get up and we need to get to work. Governor, we just have a little bit of time with you just to maybe field one question to you, if you will. We have over 1,000 participants who are dialed into this conversation. And I'm going to pick up a comment, a question that's come from Tsepo Mkayise. And Tsepo says, Governor, do you foresee a prolonged economic downturn, or was the lockdown the deepest point? Second part of Tsepo's question is, how do you see recovery in developing countries relative to developed countries? Over to you, Governor.
Thank you very much, Program Director. Let's bear in mind that the lockdown was a necessary response to the health crisis that we faced. Yes, in the process of dealing with that health crisis, the economy suffered a shock. We have now, as a country, embarked on a risk-based approach of reopening the economy. And as the economy reopens, the measures that we have taken to re-stimulate the economy, to restart the economy, will begin to take effect. And economic recovery will begin to set in. Should I be calling the bottom? Well, we actually think that the second quarter of this year would be the worst that we have seen. There are of caveats. Part of it is I hear people talk of a post-coronavirus economy. I'm sure be one, but it is not imminent. From the lockdown, the economy we are going to have is an economy where we are going to have to live with the coronavirus. That's what we are going to be facing. And there are still risks. Risks are, even the lockdown, we might have another set of infections. And we have seen various other countries. And whether you are a developed country or a developing country, the impact of these infections and how you respond to them have an impact on how your economy reacts. So it's difficult to even draw a line and say the developed countries will respond, this will grow this way, and the economies will grow this way, given that the nature of the shock has been this massive, and yet we have not yet come to full grips with the extent of this shock as things stand.
Governor, thank you very much.
I was told that there are a number of questions, but you are the program director, not me. With 1,000 participants, surely there can't be one.
So we have tons and tons of questions, Governor, and I'm very happy to field them to you. I suppose the message in my ear was the Governor is tight on time, but I'm going to take this opportunity to bring one or more questions to you. So that was from Tsepo Mkayise, and there's a couple of themes, Governor, if you will, around this particular question. That's come around, and this question is from Calvin Ing. And Calvin says, are there any reasons why the bank did not cut rates earlier when South Africa experienced back-to-back technical recessions from 2017 all the way through to 2019?
Thank you very much. Sometimes we have got very short memory. So a lot of people talk about the steps that were taken now. Most of the steps that were taken now were in response to the big shock that we have experienced, a shock which was both of a demand nature and of a supply nature. If we cast our minds back, we would actually recall that we started cutting interest last year in July. That's when the first interest rate cut took place. Took place in July last year. So we were already responding to weakness that we are we see in the economy. But like we said, that what monetary policy does for growth is that it can deal with a shock to the demand. That is what we can deal with. We can boost demand. So we are cyclical in nature. Our economy, as I kept on emphasizing, has got underlying structural problems. Even now, as we stand now getting out of the lockdown, one of the things that comes and which we must ask is government has put together a fiscal stimulus. The Reserve Bank has taken a massive monetary stimulus. And the question is, what has been the impact on the economy? You will not be able to tell what the impact on the economy is because we are stimulating an economy that was under lockdown. As the economy emerges from the lockdown, we would be able to tell what the impact of these policies are.
Governor, staying on the theme of the impact on the economy, there's a question here from Henk Kruger, which really focuses on missed opportunities, if you will. The question is this: does monetary policy ever consider lost opportunities for the South African economy, maintaining a higher interest rate as opposed to otherwise a lower rate? And the second part of the question is, how much larger would the GDP have been at a real interest rate of, say, 3%?
The presupposition of the question seems to suggest that the objective of policy is to get a particular interest rate. That is not the objective of policy. Interest rates are a tool to achieve particular objectives. And as a policymaker, there would always be trade-offs, and those trade-offs might be between policy objectives, but they are also of an intertemporal nature, which means what decisions do you take today which would affect the future? And what tended to happen, and if you heard from my talk when I talked about young people and why they would have a reason to be angry when they see the kind of debt situation that we end up with, is that they look at this and they say, some people took this decision a few years ago, and we are having to be faced with this situation now. Such is the nature of policy. Any interest rate decisions of the past which have been taken given the circumstances then and what at that particular time we thought the future looks like. So even the decisions that we have taken now, cutting rates, have nothing to do with what had happened or what is currently happening, but have more to do with what is going to happen in the future. In other ways, what has happened now, how does it affect the future trajectory of the economy, both on an inflation side and on the growth side? And that is what we respond to. So in policy, there is no such thing as a costless policy. Any policy decision that you take, you have got to weigh the trade-offs, try and quantify what those trade-offs are, look at the risk attendant to those trade-offs, and make an appropriate decision. And we actually believe that Reserve Bank, the decisions that we have taken have been cognizant of the trade-offs and took account of risks that could emerge in the future to the best that we could assess what the nature of those risks are.
And of course, Governor, hindsight is a perfect science, as many would say. But to underscore the point that you've made here, there is no such thing as a costless policy. I know that part of our audience is very active on social media right now, and I don't doubt that is certainly one of the insights that's going to come through. I have maybe two more questions, Governor, before I let you go. I'd like to pose this question from Nicholas Hout. And Nicholas says, more of a global view, if you will, Governor. What is the view of the Governor on international coordination of monetary policy? If we think about the Fed's poor information sharing leading up to the 2008 financial crisis, this is evidence of this. So the question is, how do we balance sovereignty and coordination in global policy?
An interesting question. For whilst we have a global economy, we do not have a global government. And all policies are national, even if they might impact on other countries. And in the aftermath of the global financial crisis, one of the things that as a central bank community that we spent our time deliberating had to do with the spillovers from the policy decisions of the advanced economy central banks and what those policies mean for emerging market economies. Let's take this thing back to 2010 when the Fed first embarked on quantitative easing. The way in which quantitative easing was supposed to work was that there would be a lot of liquidity in the US economy, and that liquidity will find its way to the main street, basically to the real sector of the economy in the US. What happened was that that money got out of the US and went to emerging market countries. In the process, it appreciated the currencies of emerging market countries. And that was called the spillover effect from the policies of the advanced economies. Now, policy is national in nature. The US Fed is without doubt the most powerful central bank in the world. But, underline that, they are the Federal Reserve Bank of the United States. So the decisions they take are the decisions that are in the best interest of the US economy. Yes, they are cognizant of the implications for the other economies, but in the end, the decision they take would be in the interest of the US economy. Cognizant of that, what you would have realized is that the Fed put a number of swap lines with different central banks so that they would be able to also this spillover. South Africa was fortunate to be amongst those that also benefited from one such a line. But the point here that I am making is that apart from the forums that we have as central banks, whether we meet under the auspices of the Bank for International Settlements, where we meet every second month and we exchange views on the economy, we could exchange views on the economy so that we have got at least some common understanding of where the global economy is. When we leave from there and we go home, every country takes decisions based on its own material conditions in its jurisdiction and what it sees as the outlook for its economy and what would be in the best interest of that economy. And South Africa is no exception. We participate in these global forums, and when we come back home, we have got to make policy that is suitable for our own circumstances.
Policy needs to speak to our own reality, and you're underscoring there, Governor, that we might have a global economy, but we certainly, or might be part of a global economy, but we certainly are not part of one global government. A final question for you, Governor, from Shenesu Zhu. And it's a question that brings us back home, if you will, to latch onto that theme. And the question is this: to what extent are you cooperating with National Treasury, considering your interest rates decisions could affect their borrowing decisions from the domestic market?
there are professors of economics in this webinar. They will say to you that when a central bank starts making monetary policy decisions based on what that would mean, cost of borrowing of a treasury, you are starting to venture into some form, not fully, but some form of fiscal dominance. That means that monetary policy no longer makes decisions based on the achievement of its mandate, but it does so to meet the borrowing needs of the government. And once that sets in and it becomes the reality, if not arrested, you are then going to go into a fiscal spiral where higher deficits leads to higher debt, and there is an expectation that the central bank will provide cheap funding either directly or by allowing inflation to rise and in so doing erode the real value of the debt. That is not the risk South Africa is facing. And the reason is not the risk that South Africa is facing is that, firstly, I think that the response in the supplementary budget that was tabled last month clearly set out a path or a fiscal trajectory path that would give us some certainty, which, if implemented, would alleviate pressure on the cost of borrowing in the South African economy. That is the first one. The second one is that South African government has got around 400 billion rands or so, between 200 and 400 billion, around there, of debt that is linked to inflation. That debt, it means, when inflation goes up, the government pays more in debt service costs. So inflating the debt away in that manner is not an option for South Africa. But when government tries to inflate its debt away using inflation, let's not forget what would happen. The prices in this economy will all rise. And those pieces of paper and coin that you have in your wallet or in your handbag will become just that, a piece of paper or a piece of metal. They would become worthless because there is no one standing behind those to protect the future buying power of the money. And so we're fortunate that you have a Minister of Finance who also understands the limitations of monetary policy. And so for a period now of more than 20 years, there have been joint structures between the Reserve Bank and the National Treasury. One structure coordinates monetary, macroeconomic policies, a standing committee on macroeconomics. One coordinates financial regulatory policy, and one coordinates our policy with respect to banking and financial market. So there is an exchange of information. We talk to each other, we share views, but at the end of the day, we understand who is responsible for fiscal policy and who is responsible for monetary policy. So coordination does not mean that you encroach on the terrain of the other authority. So that is what it is. Sipho, you said that I've got a message that said to me, I have got a little bit more time. So it's whether you have time, not whether I have time.
Thank you very much, Governor. Unfortunately, I have to get to that panel of professors and economists that you're speaking about. But I do want to pick up on this last point that you've made. You're speaking about clarity between fiscal policy and monetary policy. And if you link that to the generation of people you are talking about that use fiery language and are embodying some degrees of anger, I think they would describe that as staying in your own lane. So you can go and consult with your children what that term means, but the message is loud and clear. National Treasury, the Reserve Bank, each of these in their own lane. With that, I'd like to say a very big thank you to the Governor of the Reserve Bank here in South Africa, that is Governor Lesetja Kganyago. Thank you, sir, for your time and your deep insights. You've given us much to explore and unpack in the following panel discussion. Thank you for joining us.
Thank you, Nazipo.
And we're back. That's an incredible conversation with the Governor. Always a very comprehensive lesson that has its roots in the history of monetary policy, not only in South Africa, but certainly of a global context, and bringing us right down, of course, to the day-to-day and month-to-month interactions between the Reserve Bank and other institutions in South Africa. For now, though, ladies and gentlemen, we are changing gears and we're transitioning to our much-awaited panel discussion. Now, you'll remember that the topic of the panel discussion is the future of economic policy in emerging markets. I'm also going to ask you to continue sending us your questions, to continue sending us your comments as you did in the conversation with the Governor. And again, I'll try my best to bring these into the conversation. Now, I'm going to ask my panelists to do two jobs for me, or to complete two jobs for me. The first of these is that I'd love for them to respond and to react, if you will, to what we've heard from the Governor, and to share some of their thoughts around how what they've heard either sits within their specific context, or how they see the future, how this relates to the future of economic policy in emerging markets. The second job that I'm going to put to our panelists to please do for me is to, of course, to lead with their own insights, their own expertise and experience in terms of where they see the future of economic policy heading for emerging markets. I'm going to introduce them, so you'll see them popping up on screen once again. Dr. Elias Albagli, I introduced him earlier. He's back on your screen now, and he is, of course, the Director of the Monetary Policy Division at the Central Bank of Chile, which we did hear the Governor refer to in his remarks. We're also joined by Ms. Elena Rybakova, who's a Deputy Chief Economist at the Institute of International Finance. Welcome, Dr. Elena Rybakova. Lovely to have you as well. And of course, Professor Nicola Vieji, who we have described as the South African Reserve Bank Chair of Monetary Policy Studies at the University of Pretoria. And so I think my first stab at this conversation is to really get your reactions in maybe just 2 minutes, if you will. What has stood out for you from what the Governor of the Reserve Bank has shared, but most importantly, what implications do you think this has for the future of economic policy in emerging markets? I'm going to start with Dr. Albagli. If you could kick us off, please, sir, with your opening thoughts. And if you could kindly unmute Dr. Albagli, please. Okay, so I'm going to, we've got a bit of an audio issue there. We'll come back to Dr. Albagli and make sure that his audio is 100% functioning. So let me go to Ms. Rybakova next and ask for her comments, her reaction to what we've heard from the Governor, and specifically as it impacts the future of economic policy in emerging markets. Elena Rybakova, please.
Thank you so much. And also, first, I want to say thank you to the University of Pretoria, to the Reserve Bank of South Africa for having me. It's a great honor to be here. And whenever we talk about history of monetary policy studies, and also especially of Reserve Bank, it is an incredible asset to all of South Africa what the central bank has done and how it compares to other emerging markets. So that's my first reaction. And of course, speaking after the esteemed governor, I was probably particularly not surprised, but reassured by the consistency of the message. I think especially over the last sort of couple of years, but even the last 5 years, the consistency with which the central bank has brought inflation towards the middle of the target, has flagged inflation targeting, focused on modeling, been very transparent about their quarterly projection model, and even though it's confused some of the local analysts, I think that is definitely a reassurance of the commitment to inflation targeting and the independence of the central bank. So I think that's my first sort of message. Another one is, and in my presentation will be a little bit more controversial, we are talking about extraordinary times. We're talking about global pandemic, which is not a global financial crisis. It's different. It's not a shock that came from a financial mismanagement globally or macroeconomic mismanagement. It's a shock that came from a health issue. And the question is here whether it's time to consider new tools and when they can be useful, when they can be not useful. And we published recently a note on quantitative easing on emerging markets, which, as one of my friends, central bankers, said, it's a particularly vile idea. It is clearly a controversial idea about QE in emerging markets, but whether it belongs to a toolbox, either as the governor talked about as a financial stability instrument, and possibly for financing, and under what conditions. And a few academics, including us, we talked more about credibility of the central bank. Of course, it's very important. But listening to the governor, I'm beginning to understand that the credibility of the fiscal authority is almost equally important if you want to use QE more actively. And I'm very curious also to hear our Chilean colleague, because they do have a fiscal rule. Does that make it easier to use QE or this kind of new unorthodox tools at the time of crisis? So these are my brief reactions.
Elena, I think these are fantastic initial reactions. I just want to underscore some of the things that you've said. The first of these is that your assurance around the consistency of the messaging, but also highlighting the fact that a global pandemic and an economic crisis are actually not the same animals. And there is perhaps an opportunity here to pause, review what sits within our toolbox, and ask ourselves the question whether the tools we have in the toolbox are still sufficient for the new terrain that we find ourselves in. And so I love the use of this idea of a potentially vile idea, but there are conditions when even this idea might be the sharpest tool that we might have in the toolbox. I'm going to unpack that with you a little bit more in a short while. But let me go to Prof. Vieji next and also just get his reactions, if you will, to what the governor has shared with us, and in particular, its impact on the future of economic policy in emerging markets. To Prof. Vieji. And I'm going to ask you to unmute as well, Prof. We can't hear you as yet.
Hello. Yes.
There we go.
Oh, okay. I thought Elena was spot on in noticing the consistency and the strength of the message. I think in South Africa it's particularly important to discuss openly about the framework of monetary policy and what monetary policy can and cannot do. I think inflation targeting actually has been a good framework because it gave also South Africa a lot of flexibility of intervention. And inside the inflation targeting, actually, there is a lot of scope also to introduce new tools and new instruments, as long as they are compatible with the long-term objectives. I think there is, a lot of the work of macroprudential policy, a lot of the work, even intervening in the bond market for liquidity issue, but also the discussion of what we are going to do fiscal policy. I think that one is definitely a very important characteristic of the inflation targeting framework in South Africa. Also the ability, the flexibility of the framework. One thing that at the end is the center of the discussion, and that is the center of what the future of also monetary policy is the fiscal condition, and what is the role of the public institution, and what are all the fiscal policy, the role of economic policy to promote economic growth and stability. And this is, I think, is a discussion that it is the governor started, I think, introduced very important element in the discussion, and I think I'm also very interested to discuss with the panelists and to see what the people outside think that the role of the different economic institutions should be, and in particular, what is the role of fiscal policy in this situation. Yeah.
So those are really fantastic opening reactions, Prof. Vieja, and really helpful. And again, what I'm hearing is that whatever review we might be making of the tools in our toolbox, it cannot happen outside of the broader mandate of why we exist. And of course, you've raised the issue as well of the credibility of the fiscal authority that the governor raised, but as well as Elena. And I'm keen to take this to Dr. Al-Bagli, because we know that he might have some very real comments on this as well from a Chilean perspective. So let's try Dr. Al-Bagli again and pick up on his reactions to what we've heard from the governor and how this has an implication or impact on the future of economic policy in emerging markets. And Dr. Al-Bagli, if you could just touch on this precondition of a fiscal authority in order for quantitative easing to have the desired impact in the economy. So can we try to unmute again, Dr. Al-Bagli? We can see you, but we can't hear you. Okay, so what I'm going to ask us to do is I'm going to ask Dr. Al-Bagli just to reconnect, and we'll come back to him. So if you could maybe just re-enter the platform, Dr. Al-Bagli, and I'm going to maybe continue with some of the questions. Now, our participants have been very active on the platform with their questions, and so there are quite a number of questions that are quite specific. And I'm going to try my best to bring these specific questions up to the fore. So there's a question in particular that had come in from Elena, and I'm going to just pull this up in a second, Elena, so that I can bring that question to you. So I'm told that Dr. Al-Bagli is back online and is audible now. So let's try you again, Dr. Al-Bagli. Can you give us your thoughts?
Can you hear me now?
Yes, we can. Thank you so much.
Oh, great. I'm relieved. Okay. Let me begin by thanking you, Nossi, and the organizers for the opportunity to participate in this very important and timely conference. So I have some remarks, but I'll start with the reactions to what the governor was discussing in the context of the measures that the Central Bank of Chile has been taking in reaction to this incredibly challenging months. The economic shock has spread with the same speed as the pandemic, and in ways that have really startled us. At the Central Bank of Chile, we have reacted speedily, displaying a wide variety of measures. We started lowering the monetary policy rate to its technical minimum, signaling that it will stay low for a long time, specifically at least for 2 years. That was the very strong message that the monetary policy report in June put forward. We have also departed from our usual tools by the program of loan extensions to banks in very favorable terms. These are loans at a current policy rate of 50 basis points for the next 4 years. But that's conditional on these banks lending that money to firms. And thanks to these measures and to the provision of guarantees also behind these bank loans, aggregate credit has increased just as pretty much else in the economy is falling. And this is the first time this counter-cyclical behavior of credit has happened in our country in recent decades. And I think, going back to some of the governor comments, this highlights the importance of coordination between monetary policy and fiscal policy, but always maintaining independence between these two sources of policies. Now, regarding QE, this is very interesting that this comes out. Maybe you don't know this. Chile has an unusual arrangement in the sense that we are not allowed by law to purchase any securities issued by the government, not even in the secondary markets. But as we speak, literally, this week or probably the next, Congress is voting on changing this rule to allow us to access, to purchase, to trade government securities in secondary markets. Now, the concerns of this restriction are understandable, given our previous history, and I mean previously back in the 60s and 70s, of fiscal dominance. I think that has been very recurrent in these remarks. And for that reason, the board has been very clear that the way in which we plan to use these tools, if we need to, is not really related to the standard objective of QE, which is lowering rates as a monetary policy tool, but rather as a tool for ensuring financial stability. Because Chile, as many other emerging market economies, we're small, we're very open, we are subject to strong violent shocks from outside that can be quite destabilizing in terms of markets. Now, of course, we have exchange rate flexibility. We're fully committed to that, and that plays an important absorption of these shocks. But nonetheless, our rates can be quite volatile, especially in the long term. And that might induce instability in a moment where we cannot really afford any more sources of instability. And for that reason, I am happy to say, I mean, this reform looks to be working itself through Congress very, very speedily, and not a moment too soon, because we might need these tools to stabilize the country if we were to see, say, another rise in the pandemic abroad and another episode of market turbulence.
Absolutely. Thank you very much, Dr. Al-Baghli. So clearly, the context and the terrain of where we find ourselves, as Elena pointed out, is actually incredibly important for us to distinguish between a financial crisis and a global pandemic. As you say, there is a reform under review in Congress at the moment that might see an unprecedented move in Chile. But let me ask you this follow-up question, please, Dr. Al-Baghli. There is a risk of central banks becoming more political, if you will, as they take on a wider role of economic management, as they try to support government policies. How would we ensure that that risk doesn't become a reality?
So we can never ensure risks 100%, right? We can take the appropriate steps to minimize those risks. And I'm going to paraphrase our governor here. He said in a conference a while ago, when asked about this, the best way of preventing this is to show the track record of the Central Bank of Chile. We are a credible central bank. We have always put forward the best interest of the nation, and our modest contribution to that welfare is just ensuring that price stability will remain a feature of the economy going forward, just as has been a feature of the economy in the last 20 years. And when you make surveys to households, firms in Chile, many institutions in Chile, unfortunately, this is true in other parts of the world as well, have lost faith, have lost credibility in the eyes of the population, not the central bank. The central bank is very high in the perception of Chileans, despite the deterioration in other institutions. And I think this is the key asset that protects us and gives the credibility for us to venture in these new areas of policy that are very much needed to handle the pandemic.
Dr. Al-Baghli, I love the fact that you've come back to this point of credibility that's keep coming up. I'm keen to get a couple of questions that have been put to Elena on the platform, but I don't want to miss this opportunity to connect again with Prof. Vieji on this question of credibility. What does credibility mean in the context of COVID-19 for central banks? And how do you become increasingly credible in such an uncertain environment? So Prof. Viaji, if I can ask you to unmute again, thank you so much. Let's try one more time. Okay, so I'm going to come back to you. So I'm going to come back to you with exactly the same question, because I think the theme of credibility is going to be quite important. Now, Elena, I've got a very interesting question that's come through for you on the platform, and the question comes from Andrew van Dam. And Andrew wants to know, at what level of debt will the global economy no longer be stable?
Well, I think it's not just the debt that we should be looking at it. It's rate of growth, it's rate of interest that we're paying on this debt. So it's not just the level. In terms of the absolute levels, we're in exuberantly high levels, right? It's hard to imagine for it to be sustainable. And my colleagues published the debt monitor, which just keeps on going up and up and up. Of course, the neutral rate in developed markets appears to have fallen dramatically. And there are a lot of studies on the fundamental drivers of this neutral rate. One could say, and here I'm going to borrow from Olivier Blanchard, his recent comments, that actually higher debt itself could change those neutral rates. So you could have a situation, if the debt continues to increase, you could have an increase of 100 bips, 100 basis points, 150 basis points to the neutral rate. Of course, then the next question then arises, the independence of central banks, or the governor, esteemed governor mentioned, also my colleagues on the panel have done fiscal dominance. So if the time comes, for whatever reason may be, that the neutral rate goes back up, and the central banks need to increase their policy rates corresponding to the increase in underlying neutral rate, if there is fiscal dominance that prevents them from doing so, of course, then it all becomes unsustainable or financed through high inflation. And what is particularly dangerous about that, apart from the obvious macroeconomic issues that we're all familiar with of high inflation, stagflation that the governor mentioned, also what is important that if you look at the global financial markets, many are not prepared for a spike in inflation. We're not expecting either a spike on inflation, but if you look at the allocation of portfolios, it will be extremely difficult, I'd say impossible, for global asset managers, investors to reallocate to a new reality of high inflation. And I think that's a low probability event, but it could be very damaging to markets. So just very quickly on debt, it's not just the level, it's the rate you're financing it at, and also the rate of growth of the underlying economy, of course.
And of course, Elena, I had promised to come to Dr. Al-Bagli on the question of credibility, but before I move on, I'd love to pose it to you as well and hear your lens on this question of what does credibility mean in a COVID-19 environment, and how do you build credibility of a central bank in an incredibly uncertain time?
Building credibility takes time, and I think that's it's reputation building, right? It's very hard to do overnight. And I think SARB, central banks like SARB, and there are few others in the emerging markets have been successful in building credibility. In a very technical way, the way we measure it is how well anchored are inflation expectations and inflation itself. So for example, this time around we had big shocks to exchange rates, but core inflations haven't spiked as much. The pass-through, even already in 2008, including in the cases, for example, Chile or Latin American countries, very different to what it was 20, 30 years ago. So the pass-through from exchange rate movement to inflations are much lower. We can measure that statistically. Inflation expectations are better anchored. When headline inflation moves, you don't see a proportionate move in inflation expectations. I think that's another important factor. So these are things that not only we can sort of talk about and feel, but it's also something that we can measure, and that is built over time. In terms of the crisis, of course, we economists always say it's bad to exit fixed exchange rate in a time of crisis or make adjustments in a time of crisis, but reality is that oftentimes central bankers have to do it in a time of crisis, and crisis can be an opportunity. And if you look at the 2008 and 2014 experiences in Russia, for example, where the central bank used the opportunity of crisis, moved to flexible exchange rate regime, and actually hiked rate aggressively at the time, and by the time this crisis came around, they were much better prepared. So again, credibility is not something we only talk about, it's something that we can measure in empirical studies.
So again, it's something that is empirically measured, but you also talk about the reality that it does take time. I'm keen to get Dr. Al-Bagli back on the line. And Dr. Al-Bagli, if you're back, the question of credibility and how do we build it in times of uncertainty?
I'm glad that you're asking me this again. You know, there's this analogy that keeps coming into my mind since we started this crisis, and that's about what it means to be cautious and responsible when you make decisions from the central bank. And the analogy is the analogy of the avalanche. When you see an avalanche forming in the mountains, the cautious response is not wait and to be sure about what's really going on before you make decisions. The cautious response is to start running, right? To react fast. And reacting fast means you might make mistakes. But I think what gives credibility, and we see this in the surveys that we do at the bank, is that you build on your expertise, you build on the knowledge of the people that work on the bank, and to the best of your abilities, you make decisions fast. And we have made decisions fast, faster than the first print of real activity, faster than the first print of unemployment since the crisis began. So when these measures arrive, which always arrive with a lag, and they confirm your suspicious, your views, you have already started making decisions. And I think the public values that you might make mistakes, but that you are acting in good faith and that you're not being scared of taking the decisions that you feel are the best for the current circumstances.
That's a fantastic view, and I'm going to try and test it with Prof. Viaji. Prof, the rate of reaction, responding fast, as some of the thoughts that Dr. Al-Bagli has shared with us. In your view, how do you build credibility in times of uncertainty?
Allora, I think the issue of credibility is also contingent to a particular place. We can build credibility of the central bank, and I think the track record of the South African Reserve Bank, the track record is a track record that tells that the South African Reserve Bank is a forward-looking and aim at the stability of the currency. The problem that we have is the credibility of the whole system around the central bank, and therefore the sustainability of the credibility of the central bank in a system around which that is not very robust. The problem that South Africa has is that we arrive at this crisis essentially without insurance, without any other shock absorber, either the monetary policy. And likely we were lucky to have the monetary policy the way it was, therefore with a lot of room of maneuver. But we have very little fiscal space, an economy that is traditionally bad in answering shock. Therefore, after the global financial crisis, we lost 1 million jobs for a shock that in South Africa was a mild shock. Therefore, we lost in absolute number more jobs than Germany that was hit directly by the shock. It took a very long time for that employment to be recovered. Actually, we just recovered the amount of employment that we had before the global financial crisis at the moment that this crisis hit. And now we are expecting another 3 million unemployed. And we know that the economy is very slow in absorbing this. We don't have also shock absorber or if you want insurance mechanism in things like skill of education, flexibility of the economy overall, ability of the economy to respond to this uncertainty. That we need to realize that this one is not the last shock. We need to build up a system that is resilient to many more shocks going forward. We are a small country, a small open economy. This kind of shock, we had 2 global crises in less than 10 years. And we can expect the possibility that this kind of, not the pandemic, but economic crisis might happen. What are we going to do to make this economy resilient to this. In this context, then the central but the discussion must be more systemic so that the central bank can really fulfill whatever they need to achieve.
Prof. Kganyago, I think I want to follow up on that because you are touching on one of the points that the governor had raised, and this idea that monetary policy on its own is going to be insufficient to get us back on the fiscal path where we're also seeing the creation of jobs and we're seeing growth in the economy. And you talk about having to build resilience by looking at the interventions at a systemic level. Now, if you look at the South African context, my question to you is, where do we start as we begin to think strategically and deliberately about how we rebuild the South African economy in mind of the fact that we do have some monetary policy space to play with? What would you prioritize as a way of making sure that we're getting back onto the fiscal path and we are beginning to realize some sort of economic growth?
Let's think how we got here. The South African economy, after the global financial crisis, therefore in all this period, was a combination of a necessary macroeconomic response, the fact that the government became the employer of last resort, was the main source of employment in the economy. There is no other sector that was employing as much. It was the source, especially the state-owned enterprise, was the source of rent extraction, clientelism, and corruption. None of those interventions that we did in the last 10 years have any significant impact on the growth of the economy. Therefore, there is nothing in the debt trajectory that we had up to now that has helped in any way the change and the transformation of the economy. Therefore, now is the moment of deciding where are the area of really important intervention. Eliminating rent extraction, eliminating clientelism and use of public resources private interest. This is definitely the first, and the president is clearly aware of the importance of this first step to build the credibility on the fiscal side. Concentrating the public resources in education, health, and support for the poor in our economy. Those are the three main, and not only resources, but we need productivity in those areas. It then starts to reactivate the economy and believing in a private economy that can reactivate. Therefore, we need to reduce the power on the incumbent and allow more new entrants and new dynamic to enter in the economy. Therefore, some of the treasury idea in this one are useful, for example. But those elements, I think, and importantly, when we decide, we need to decide who has to pay for whatever the public purse decides. That is not an instrument of development. Even an expansion of welfare state or an expansion of the role of the state in education and health must be matched with a decision of how we finance and what is the role of this financing instrument for long-term growth of the economy. That is, I think, if we just decide that that is not an instrument for development of the economy, I think that one would be already quite a big step forward.
Thank you very much, Prof. Kganyago. Debt is not an instrument of development for the economy. Certainly a strong insight there that I don't doubt is going to be picked up by many in this conversation. I continue to encourage all of you that are sending us your incredible questions that we are weaving into this conversation. I do want to change directions a little bit, and I'm going to come to Elena with this first question. I mean, we started off this conversation reacting really to what we've heard from the governor, but almost with an implicit understanding that we are seeing a widening of scope, if you will, when we begin to look at the role of central banks more broadly in the economy. The question that I'd like to pose to all three of you, and to start off with Alina, with the expansion of this role, what are the risks that we need to be alive to, and to appreciate, of course, what Dr. Al-Bagli said? He says, you can't take away risk. So how do we best manage for the risks that are emerging as we're seeing a widening scope and a widening mandate, if you will, of many central banks in emerging markets? I'll start off with you, Elena. I'm going to come back to the question of financing for Prof. Vieji a little bit later on. But for now, how do we manage the risks that come with a widening scope?
Well, I think I want to just step back for a second in terms of the widening scope. I think something has to do with the way we approach macroeconomic modeling, especially for policy advice. And it has been going on for a while. The second one is the much widening scope of the developed market central banks. That's where it really started, and it's very much linked to the global financial markets. And then I'm coming to the emerging markets central bank roles. So on the first one, we have seen an increasing amount of sort of a swing in the policy literature towards monetary policy. Why? Because it's perceived to be less apolitical, faster, easier to react. So we see in a lot of policy recommendations somehow sort of removing fiscal policy, saying, well, it's too political, it's hard to agree on the budget, it's going to take a very long time, much longer lags. Why don't we go towards monetary policy? And I think in a lot of policy recommendations already in our profession, without even political pressure, we sort of moved ourselves away from considering two hands. We just started sort of leaning always on one hand, monetary policy. So this is one aspect of policy modeling. On the other side, the global financial markets, as you have seen in spring, it took few hours for the treasury market, global US treasury market, to disintegrate fully. So you have complete dominance of the global markets by the global financial institutions, and therefore the central banks are almost hostages to that. They know that they have to be there providing liquidity. And I think that's what's spilling over into the emerging markets. So now I'm coming to the emerging markets, and it's really linking into what Professor was talking about earlier, resilience. In South Africa, it's incredibly important to nurture that domestic investor, domestic institutional investor. It's one of the few emerging markets that is blessed, mostly because of the role of the central bank, of SARB, of the very sort of strong institutional quality of SARBs, of having a deep domestic institutional investor base. And in the world where we will have more of this violent swings of portfolio flows, driven by these global institutions and benchmark investing, for example, and lack of FDI investing, I think building that resilience and domestic investor base is incredibly important. So when people take, sort of say that, well, SARB should do more of social policy, you know, they should cut rates and there will be wonderful, you know, credit expansion and it's going to help it to all. Well, don't forget that you're then setting up yourself to complete destruction of the domestic investor base. And the moment you lose domestic investor base, you lose any defense or buffer from the violent swings in the portfolio flows. And I think that's my biggest sort of advice.
Sure, that's an incredible insight. So back to the question of resilience and how the domestic investor base, one that is fairly strong in South Africa, that the destruction of this reduces our buffers and reduces resilience quite significantly. So let me build on this and let me go to Dr. Al-Bagli with this very same question. Your thoughts, Dr. Al-Bagli, as we begin to engage with the reality of potentially a widening scope and the inherent risks that are likely to come from this and how we mitigate for that.
Thank you, Nasi. I think we should not mix a widening of objectives with a widening of tools. If we want to protect credibility, if we want to protect the achievement of our objectives, I think what we have to do is simple, is you stick to your guns. Let me give you a very clear example. There's this threat looming that will reignite, and we will all start thinking about it after the COVID crisis is done, which is climate change. And at the bank, we are getting involved in this challenge. But at the same time, we realize that the way to react to this the main tools for reacting to this challenge do not lie with the central bank. Central bank can have an opinion, can have a knowledge about this, can have ideas, but this is not for the central bank to do. This is just one example. I think that as long as we don't change our objectives, but we adapt and we search for new tools in order to deal with new challenges, but always sticking to our script, to our objectives, then we will be effective. Then our credibility would be maintained. I think this crisis is a good example. What have we done at the bank? We have not changed our objectives at all. What we have done is try to come up with new measures given the change in the scenario. I mean, this is the strongest, the deepest crisis we've experienced by far since the central bank became independent in the early 90s. And because of the unprecedented nature of the shock, well, our usual tools are not enough. To start digging in the toolkit, be creative, react fast, but always keeping in mind that our goal is price stability. Now, when you have credibility and you maintain credibility, it happens to be the case that achieving price stability is perfectly consistent with stabilizing the real side of the economy. So indirectly, by targeting price stability, as long as you have credibility, you will do at the same time a successful stabilization of growth and labor markets. And if I may just very quickly, actually I plan to make more comments on this, but
go ahead.
I'll stick to the time. I think there's another very important thing that we need to start doing. And at the central bank, we have been investing on this for the last 5 years, and it's starting to bear fruit. So I would like to share these thoughts with you. And this is an investment in information. We need to stop relying on the CPI index, on lagged sources of quarterly growth, on unemployment rates which are published with more than 2 months lag sometimes. We need to start building and investing seriously on information, because information is growing. And this excuse that, no, there's not good information out there or we cannot access it, this is just, doesn't cut it anymore. I mean, information might not have been there 10 years ago, but today information is plenty. And it's usually outside the central bank. And I think the central bank has to make a very conscious effort, a very specific effort to basically build this information and make agreements with other institutions. Let me give you an example. In this coming monetary policy report, we are working on a box that will allow us to study the following. We will be able to measure the drop in sales of every single firm in the Chilean economy with a lag of about 3 days. We will be able to see all job losses at the firm with a lag of about 1 month. And we will be able to see the access to credit markets of every single firm in the Chilean economy with a lag of also about a couple of weeks. And therefore, we will be able to answer, given this new information, whether the expansion of credit that I alluded to earlier is actually getting to the firms that need it, and whether this access to credit is actually mitigating the destruction of jobs and the drop in investment. Maybe we run into a surprise. Maybe we will find that credit is expanding, but this is just basically the firms that are doing fine and have access to credit. And why is it important to know this? Because, well, if that's the case, then we are being pleasant in thinking that, well, credit is expanding, everything will be fine. And then we'll find out 6 months down the road, when the data really arrives, the hard data, that 20-30% of the firms in the country are bankrupt. In order to realize this in real time, there is no alternative. We need to invest in information. And this information is not in the bank. We need to go out and build partnerships and build agreements with other institutions. Thank you.
So, Dr. Abagli, some really incredible insights. I want to just maybe lift a couple of these. One of these that you made in relation to the question of emerging risks and how do we mitigate for these is you spoke about us not conflating issues and the significance of being clear about a changing mandate or objectives versus an increase or an expansion in tools. And I think it's a very important point of clarity that you share with us. But then you come to this thought around being deliberate about investing in data, and I think most of us will agree that they say data are the new diamonds. Data is the new resource that really translates into an asset in different markets. And this is probably a reality that one finds across many African markets, and not just a phenomenon of central banks, but the general phenomena of data that lags reality. And so a quick follow-up question to you. Assuming that central banks started to invest in information, starting to build partnerships that give us almost real or live data, what superpowers does that give central banks? Why would this matter in the sense of the impact and the role of central banks in the economy?
Well, it would matter because, I mean, going to the title of this session, what are the future challenges? I mean, we have no idea, right? You asked me 1 year ago, what are the future challenges? I would have told you the trade war, climate change, some crisis in some emerging market that might hit on us. I would have never said the pandemic. Even worse, when the pandemic arrives and we know it's a pandemic and we know there's going to be shocks, we start looking at the data and then you see relations that just don't make sense. They don't follow the prior idea that you had on how these shocks are going to play out. So the only way of being able to react fast and react with the appropriate design of tools is to figure out in hopefully real time what is actually going on. And you are not going to find this out. You're not going to gain any significant insight from waiting for hard aggregate data. This is just not going to happen. But when you open the box, when you do a double click, you look at firm level data, and this is like a spider web, right? Every time a household or a firm makes a transaction, at least in Chile, but I'm pretty sure this is going to be true in many countries. Every time a firm or a household makes any single transaction, from registering their car to buying a TV or the firm buying a pinhead from another, that leaves a trace. And this trace, if you start connecting the dots, you build this sort of spider web where you have basically all, or you can have most of the micro data, whether it's generated by public institutions or private, you have them connected. So you have information about the firms, you know who the firms are hiring. These people that they're hiring, whether they have the banking sector or not. There's just the degree of richness of this data is just amazing. And it's a long investment. It's a long investment in making the agreements, getting this data together, building teams which are multidisciplinary.
Yeah.
These are not teams of economists. You might have an economist or two, but these are not the guys leading the effort. I mean, these are data scientists, engineers. And once you start getting into this and you start seeing the benefits of this, to me, there's just no turning back. If we want to be able to react fast and the appropriate way, not just to the COVID crisis, but the ones laying ahead of us, we need to see detailed information about the economy, and we need to see this information fast.
I think it's a great insight, Dr. Al-Bagli. One of the conversations that has come out, in the context of COVID-19, especially in South Africa, is the extent to which the pandemic has laid bare and exposed some of the underlying fragilities that we have in our economy. And certainly what I'm hearing from you saying is that what this pandemic has also done is also expose the extent to which the data that we are relying on to make decisions is oftentimes too late to be effective in terms of the sharpness of those decisions and the sharpness of policy. And what what really stood out from what you shared to me is that We cannot, as central banks, find ourselves in a position where the response to a question is, we just don't know. When we have data, it gives us a little bit more light in an otherwise gray area. I want to come back to Prof. Vieji now on this same question, Prof. We've been having a conversation about the emerging risks to widening scope, and in your view, how do we begin to mitigate these risks as best as possible?
I thought that what Elias just said was very topical, very also important in thinking about the relationship between policy institution and research institution. Therefore, when I talk about the resilience of a country, is also to have the capacity of innovation and the capacity of mobilize the intellectual research and capacity of the country to deal with these new challenges and new challenges that we are going ahead. This issue of the data, what is our real understanding of how the economy works? How can we act fast to a change in circumstances? Is I think is I'm really that's why we try hard to have somebody from the Bank of Chile in this discussion, because the Bank of Chile has always been at the avant-garde, at the forefront of the innovation in central banking, and really thinking central banking in a sort of forward way, and that's exactly the kind of information and idea that we need to develop, really to understand what the dynamic is. I mean, after 5 months of this crisis, in South Africa, we are still blocked in transferring of funds by the bureaucratic process of determining who can or who cannot get the 350 rand that we. So that we have an administration, we have a bureaucratic structure that still think in terms of, very slow process, a very complex process. Why instead, especially in an uncertain environment, one of the conditions for resilience is also fast adaptability and research-based, information-based decision. Therefore, for example, one of the things also in South Africa is quite typical when we talk about economics is a sort of an idea that economics is some sort of ideological battle that we are, for the central bank is on one side, somebody else is on the other side. But actually, economic policy is always having information and understanding what the trade-off of the different decisions are. Is the policymaker to decide how the trade-off should be solved. But it's our role as an economist and as a research outside and inside to really understand exactly what the trade-off is, to really collect and analyze data information so that the policymaker can make decisions fast and appropriate. Because at the moment we are going blind. Even in this crisis we are going mainly blind. And this one is a significant problem, yes.
So, Prof. Vieji, fantastic contribution then again highlighting the innovative stance that we've seen from the central bank in Chile. And I think there's two points, amongst what you've said that I'd really want to bring to the surface here. The first is that it really has to be about data-driven decisions, and which of course is a reinforcement of what we've heard from Dr. Al-Bagli. But what I'm also hearing is that data-driven decisions don't just allow us to be agile or to be fast, but they allow us to be informed and therefore to be fast, because we have the data and the variables that give us some sort of direction about what the next move could be. Now, I've got about 10, maybe 15 minutes max left for the panel discussion, and I really want to dedicate it to lifting a lot of the questions from the platform. So maybe, Prof. Vieji, let me just stay with you here, because there's a question that links to one of the last points you've made in your previous response. You made a profound statement and you said, debt is not an instrument of development. So here's a question that comes from the platform. Should South Africa need more debt funding? Where will they be able to obtain it from? And will they have the ability to apply for more debt? Your thoughts on that?
But we are expecting a path of increasing debt. Therefore, we are expecting that for the next few years. South Africa has got a good access to market still. And the relationship with the IMF, the intervention of the IMF is at the upper end of the possibility in terms of financing part of this debt. I would, for me, the issue of debt in South Africa, one of the things about South Africa in 1994, I think South Africa had more or less the same discussion. The discussion of debt at that time was an issue of self-sovereignty. That if you base your development on borrowing, both from international institutions, also from the market, essentially you constrain the range of policy decisions that you can make. And therefore, an independent and sovereign country has to think about the long-term path of development on the basis of the resources that they can mobilize. This one was the idea in 1994. This one was very much the foundation of the credibility of the South African institution. The ability to borrow in the market that we have now is sort of a legacy of that tradition. The ability to borrow in your own currency, the liquidity of the market, is a legacy of their own tradition. Therefore, we are using the buffer stock of credibility that was built from 1994 onward. And we have to be very careful and not spend totally that buffer stock and that legacy of credibility, because then the next time we are not going to be able to borrow in the market. Then the next time we end up a sort of a Greece. Therefore, we lose sovereignty as somebody else, we decide what kind of policy South Africa should make. That is where I see the risk when we talk about debt, or even when we talk about monetarization of the debt. The risk is not in itself the monetarization of the debt. It is possible in a sort of as a short-term intervention, but the risk is that if it's not clearly an extraordinary intervention for the COVID-19 period, you are wasting totally that credibility, and then you are never going to access market anymore. You are never going to the cost of borrowing, a level of sovereignty will go down. And I think that is in the discussion of the debt. When I say debt is not a source of a way to finance development, I think I'm going back to what the experience of South Africa was, what the discussion in 1994 was, and I think that they build up that credibility and legacy, and I think this generation should not waste it. That's my.
It's a beautiful way of closing off this your response, Prof. Vieji. This generation should not waste it. I'm going to come back to you after I go back to Elena, just to talk a little bit about the stress testing of the banking sector, if you will, and whether the Reserve Bank has been aggressive enough in terms of supporting the banks. This is a question that has come from Nico Mkiba. But for now, let me come back to Elena. Elena, I want to maybe lift the conversation to a little bit of a global horizon with you. The question being this: what is the role, in your view, of international cooperation in dealing with global shocks? And in particular, when we look at emerging markets, and can they credibly respond to these shocks without necessarily always operating within the framework of international cooperation? Your thoughts?
Thank you so much. This is a critical question that you're raising. I think global cooperation is notable this time around for its lacking. I think even compared to 2008, the response of the G20, even the response from the IMF and the World Bank has been very very limited. And I think that's very worrisome because it is a pandemic and there is a clear role for the global institutions to respond. So what are the global institutions, what are the options, right? So we have the IMF and the World Bank, and we talked a lot about the loss of sovereignty, and I think also Professor Vieji very importantly said loss of sovereignty happens whether you borrow from the IMF or you borrow from the very volatile global financial market. But the borrowing from the fund is very small. It barely matters. It took a long time to negotiate, partially because of debt sustainability issues, but it's tiny. It's almost in the South African context, it helps, but it's almost irrelevant given the size of the pandemic shock. And it's the same case for a lot of emerging markets where they have this very big debate internally about whether to go or not to go to the fund, but you're going for very limited amounts of money. And I think, of course, Chile is an important contrast. Very few countries that manage to get access to the flexible credit lines, which are unlimited, of course, then they're at a completely different level. So the global response for this the borderline cases, I think, is inadequate, and that's very important to keep in mind. If you look at the Fed, we mentioned, and the governor also mentioned the swap lines, but the swap lines are available only to a couple of emerging markets. Mexico had it already in a way via NAFTA, so it was topped up. We have Brazil, and I think it's Singapore, and one more country which is not been clear that you still classify them as emerging market. Then if you have access to repo lines, but repo lines assume that you have treasuries that you can sell to the Fed. I mean, you can probably also sell it to the market. In a way, it's almost beneficial more to the treasury market than it is to the country that is getting this repo line. So again, the Fed swap lines, yes, they're faster than they happened in 2008, but they're very available to very few emerging markets. In terms of regional arrangements, the only credible regional arrangement you've seen is in Asia, but that one also hasn't been tested. In LATAM, it's very small. In Africa, it's still also very small, although some money is forthcoming. You also have seen some money from BRICS. So again, these global or regional arrangements are very small. So in the end, emerging markets in this pandemic have been largely left to think for themselves. And here we have an unfairness issue. Those like South Africa that did not have fiscal space already coming into the shock because South Africa thought that they have more time. And exactly a year ago, we kept on debating, is the other authorities moving fast enough? Or maybe we have time. What could possibly happen? Well, a global pandemic happened that puts the debt trajectory on almost unsustainable path. And I think that's where my colleague on the panel, Ellis, was very important saying that we should look at new tools, but we should not be revising our objectives.
So that's really, really interesting, especially as we're seeing, this what you describe as an unfairness, if you will, playing itself out. I want to test something with you, Elaine, if you will. So in a recent conversation with David Rubenstein, he introduced this concept of submerging markets. This idea that over time, because of the impact of COVID-19, some emerging markets are actually really going to become submerging markets because they don't have the resilience or the credibility, if you will, in terms of their monetary policy interventions to effectively respond to the COVID-19 crisis. A quick thought on you. The possibility that the emerging market category is going to get significantly smaller and perhaps we begin to see submerging markets as well?
I think you're already seeing some of the fragmentations where the key big emerging markets are coming towards almost developed market-like status. And I think, you could say Chile is among those, you could say in some cases, certain instances, Czech Republic, Poland. You see the separation. And then you have other emerging markets that are going their separate way. And you could criticize Turkish policy, of course, and they've changed their objectives, you could say. But they're also saying that we don't want to be reliant on the portfolio flows, on the short-term portfolio flows, and we're looking for our different way. So I think in terms of the submerging market and context of South Africa, it's extremely important to think about social economic issues, that the average temperature in the room is not good enough. And I think given the history of South Africa and also the history of the 10-year or more, of almost a decade of mismanagement, it's hard to unwind. But on the other hand, it's important to remember that the whole country is paying for a handful of people that are getting this very strong budget support. Yeah. And these are SOEs and the public wage settlement agreements. And yes, it's very unfair to be addressing that in the middle of the crisis, but it's also very unfair for the rest of the country to be paying a very heavy price for a handful of people. And I think that's very important going forward.
So I've got literally 2 minutes left in this conversation. I want to close it off in a fun way. But before I get to closing off, Prof. Vieji, a quick comment from you. Can banks remain operational under the current circumstance? And can the Reserve Bank or central banks broadly do more to support this sector?
But South African banks are quite very robust, very strong. Therefore, I don't expect, a very negative show. There will be definitely a stress. Therefore, some stress tests at the bank. I'm sure the central bank are looking at some stress tests in that area. In this one, I go back to what Elias was talking about. Having a very real-time picture of what is happening in the bank balance sheet. What are the bankruptcy that we see in the firms, and what are the credit condition or the credit insolvency that the bank support will be extremely important. This one is instrument that we should definitely develop. But I think there is, in that sector, I think there is enough buffer stock to sustain.
So quite a robust robust banking sector, rather. So here's the fun bit before we go to our vote of thanks. I'm going to ask you to close off this conversation by imagining a big billboard. And the billboard starts with the following words: the future of economic policy in emerging markets. And then you need to complete the sentence. Now remember, I know professors and academics like to try and give me a thesis or a dissertation on this. I'm not asking for that. I'm asking for a billboard. I'm asking for less than 10 words. And the sentence starts off with the future of economic policy in emerging markets. Complete the sentence. Now the beautiful thing about this is we're on a virtual platform, so you can't look away from me and try to pretend that I can't see you. So I'm going to start with Dr. Al-Bagli because he's looking away the most. Dr. Al-Bagli, let's start off with you. The future of economic policy in emerging markets. Complete the sentence.
The future of economic policy in emerging markets is going to look a lot like the past if we don't study the past and learn from it.
Fantastic. It's going to look a lot like the past if we don't study the past and learn from it. That's a big billboard, but it's a powerful billboard nonetheless. We'll give you that. So let me see who looks like they're game for to go next. I'm going to go to Elena next. Elena, your thoughts. The future of economic policy in emerging markets.
We'll have to focus on the social economic issues, on inequality. Because without support of the...
So I'm going to jump right in there. We're getting a professor response and we're getting a long dissertation. Let's go. Short and sharp. The future of economic policy.
The future of economic policy in emerging market will give us a lot to study going forward. There is a lot of PhD to do. Yes.
I'm going to take the last part. The future of economic policy tells us there's a lot of PhDs that need to be done. All right, Elena, I'm going to give you a final opportunity to take us home. I think you can outperform the gentleman. The future of economic policy
is focus on the social economic issues. We need to have support of the whole country to do policy changes.
All right, I'm going to take the first part. The future of economic policy in emerging markets must focus on social issues. A very big thank you to our panelists. That's Dr. Al-Bagli, Madame Elena Rybakova, and of course, Prof. Nicola Vieji. Thank you so much for making the time to join us and for an incredible conversation. With that, now, I'm going to turn our focus to the vote of thanks very shortly. And just in time to take us home now for our vote of thanks, we have Prof. Steve Koch, who is the head of Department of Economics at the University of Pretoria. To Professor Koch, please.
"2020 marks the 100th year anniversary of the founding of the Economic and Management Sciences faculty. The faculty's beginning can be traced to back to lectures in economics and banking that were first presented by Professor McFadden in 1912. In 2021, we will be celebrating the South African Reserve Bank's 100th year in observation. Just over 20% of that has been underpinned by inflation targeting. This intertwined history, has led to a close relationship between the University of Pretoria, the Department of Economics, and the South African Reserve Bank for quite some time. It's included former professors who have served as governor and vice versa. Today, we have had the opportunity to celebrate that history and begin to imagine a new future. Admittedly, it is one with many challenges and therefore offers us new questions and new approaches. We thank the current governor of the South African Reserve Bank, Mr. Lesetja Kganyago, for giving us some insight into both the past and the future of monetary policy. We would also like to thank representatives of the University of Pretoria, especially the Vice Chancellor and Principal, Professor Tawana Kupe, and the Dean of the Faculty of Economic and Management Sciences, Professor Elsa Bilutz, for their participation and support of this occasion. We would also like to thank our moderator, Ms. Nazipo Chabalala, for managing the discussion and keeping the conversation going, and I might add, very fun. Thank you as well to our panel consisting of Dr. Elias Albagle, the Director of Monetary Policy Division of the Central Bank of Chile, Dr. Lena Rybakova, who is the Deputy Chief Economist at the Institute of International Finance, and of course my colleague, Professor Nicola Viegi, the South African Reserve Bank Chair of Monetary Policy Studies in the Department of Economics at the University of Pretoria. We thank them for their engagement and for enlightening us with their experience and their ideas. And most importantly, we thank you, the well over 1,000 participants who joined this conversation and asked us questions and made us think a little bit harder than maybe we wanted to. Thank you all, and enjoy your evening, or morning, or afternoon.
Yes, on that note, it's goodbye, it's good evening, good morning, good afternoon. Thank you very much, Professor Koch. For myself, Nozipo Shabalala, it's been an absolute privilege to serve you today. Until next time, it's goodbye.
Tomorrow belongs to those who prepare for it today. A seed planted today takes root and grows into a tree that bears fruit in the future. Over 110 years ago, a seed was planted. Today, that seed, the idea of excellence, has grown into the University of Pretoria, South Africa's largest contact research-intensive university. 9 faculties and a business school are spread across 7 beautiful campuses, which are home to over 50,000 students, ready to make an impact in the world beyond university and join our global network of nearly 300,000 alumni. Future-focused, sustainably developed facilities and cutting-edge multi- and transdisciplinary research are underpinned by a desire to transform lives and have a positive impact on communities and the world. Excellence in teaching, learning, research innovation, arts and culture, and sports puts us firmly amongst the world's best universities. Knowledge is not just what is in books, it is the wisdom to apply it, to nourish and nurture the seed so that it takes root, grows tall, bears fruit, and branches out. UP plants that seed, that tiny bit of curiosity, creativity, critical thinking, hope, the desire to care, respect, help, and innovate against all odds, to grow, to leave your mark, to excel, to challenge the norm, to think, to rethink, to discover, to inquire, to lead, to have courage, to make a difference, and to persevere. This is the University of Pretoria. We make today and every day matter.